Hey folks, good afternoon. Today is Wednesday, June 5th, and this is our June market outlook and economic update video. And lots to talk about today, but first, just a quick plug to remind you about our 12th annual client dinner coming up on Friday, July 19th, to be held at the historic Bond Ballroom in downtown Hartford. And I'm very excited to share with you that our keynote speaker will be none other than David McKnight, author of the best-selling book Power of Zero, and also Tax-Free Income for Life. Regular invitations will be going out in about a week or so, but if you're already certain that you would like to attend, please feel free to call in to join our super secret reserve seating list. But of course, you can watch for the regular invitations in your mailbox very soon. Also, I'm very pleased to share with you that our summer intern program is in full swing. And I'd like to introduce you for our interns for the summer, and you can review their profiles on the Our Team section of our website if you would like as well. First on the hit parade is Cameron from UConn.
Hello.
Joining us in our Power of Zero department. And some of you will likely be hearing from Cameron shortly to talk about your index lock-in programs and principal protection programs and similar stuff. And let me also introduce you to Abby.
Hi.
Abby is working in our wealth management department and also our client service department. And Abby will also be reaching out to people to work on account rebalancing and other important items in that area. Both Cameron and Abby will be at our client dinner, and you'll be able to meet them there. And I'm excited to share with you they're doing a great job, and I know that you'll be happy to meet with them also when you see them soon. Right, so let's talk about the market. And you might remember in previous market update videos, we've discussed over and over that the market is likely to go sideways and bore us to death or annoy us to death for probably a number of years. In fact, some of you might remember at the 2021 client dinner out at the beach that we talked a lot about a coming economic winter and that the market would likely go sideways for quite some time. And sure enough, the market hit its high point in the fall of that year at a little over 36,500 on the Dow, and we're only slightly above that right now. We've pretty much experienced exactly what was predicted, a whole lot of noise, but no real forward movement. And the frustrating part is that now, we still have a number of years probably to go. We've seen this before too. We saw it after 9/11 that the market pretty much went sideways for about 10 to 12 years with a lot of up and down and a lot of volatility, but no real forward progress. And we've seen that in the 70s also and a few other times as well. I believe that FOMO, fear of missing out, is driving a lot of this market updraft that we've been seeing from time to time. Fear of missing out on the AI rally, which is essentially being driven by only a small handful of companies whose prices are now being bid up to basically stratospheric levels. Barron's Magazine recently published an article that suggests that valuations are way out of whack. And valuations are the measurements of stock price relative to its capacity to generate earnings, as well as some other metrics. And Barron's and many others have observed that the price of stocks relative to their value is getting pretty expensive. There may come a day when artificial intelligence, AI, is wondrous and makes all kinds of money for people. But so far, the only company really making money with it is NVIDIA, because they make the equipment that makes AI work. And we saw something similar to this back in the dot-com days with Cisco. And Cisco made the routers that made the internet work. And at first, they were the only profitable company with internet stuff because you have to build the infrastructure for these things first. And in the end, the internet made everyone a lot of money, but we've learned it takes about 5 years before a new technology really becomes economically viable. We still have a way to go before we really know what AI does and how to make money with it and who the winners will likely be. And AI is not likely to be the panacea that everybody thinks it is, at least in the short term, in terms of reducing risk and building profitability. But I'll tell you, a lot of people are getting really batty about the whole thing. Recently, I received a phone call from a client who told us to sell nearly everything out of their IRA account and put it all into NVIDIA stock. And I called them back out, I literally said, do you realize this is crazy, right? And they said yes, but they want to do it anyways because their brother made a lot of money with NVIDIA and he said that they should invest in it too. And when I hear things like that, I know the end is near. Warren Buffett once famously commented that he knew it was time to sell out of his equity positions before a big crash when his shoeshine boy was giving him stock tips. And I think we're getting close to something like that again. This market is overripe for correction. And remember, there are two ways this market can correct. One is to bore us to death and go sideways for many years, which it has been doing. And the other is that 20 to 30% fall off or meltdown that we're sometimes familiar with. And I don't know which one it's going to be. But I do believe the metrics support that we are likely to struggle in this market still for some time to come. We've now seen these so-called once in 100-year events 3 times over the last decade or so, between the COVID meltdown, the financial meltdown, and now the bond meltdown. We are living in times that are very different than we've experienced before. We've learned that the 60% stock and 40% bond portfolio doesn't really work the way it used to, and that sometimes bonds don't do what you want them to do. In our office, we think a lot about drawdown. And drawdown is the amount of money lost that you experience when the market takes a dive. And when you think about how long it takes to build the wealth that you have, you become more and more worried about protecting it. Making money becomes less important than protecting money. For instance, if you invested $500,000 and we grew it to $1 million over 10 years, but then in the last year it takes a 10% dive, you don't remember the $400,000 that you made. You only remember the $100,000 or 10% that you lost in the last year. That's drawdown, and that's painful. What's my point? My point is we should continue to exercise caution and look for investments that deliver predictable and stable results. I do think there is some money to continually be made in equities, but I think they are becoming increasingly risky and increasingly expensive. Ask yourself this very simple question. What would make you more upset? Whether the market goes up big time and you miss out because you were too conservative, or the market takes a huge dive and you get demolished because you were too aggressive. Think about it this way. If the market goes up and you miss it, well, you still have money left. But if the market goes down big time, you might not have a lot of money left after that. Especially as we approach the time when you need to rely on your retirement savings, perhaps we should be dialing back the aggressiveness and looking for things that deliver stable and predictable results rather than those double-digit returns that we've become accustomed to pre-COVID. Those days are gone and frankly might not be coming back anytime soon. Let's take a quick rundown of some of the recent news articles that I've been collecting. I think there are 5 or 6 hot topics right now, and the first one that we should address is national debt. We all know national debt has reached record highs and that in the long run, it is unsustainable. One research analyst says that spending will break U.S. equity markets. America will be left with severe, irreversible scars. Billionaires Jamie Dimon and Ray Dalio sound the alarm on burgeoning government debt. And we've seen these kinds of things over and over again. And some people just don't seem to be worried about it. In fact, one of our preferred research departments asked companies in a recent survey if national debt was affecting their bottom line. And nearly all of them said no. No surprise there. The question is, how long will it take before it does start to affect the bottom line? I mean, think about this for a second. What if your household was mortgaged to the hilt and you were spending 96 cents of every dollar that you earned to pay the interest on the debt you already have. But for some miracle, you were able to borrow on top of that to meet your daily expenses. You're using debt to pay the cable bill, the grocer, the utility bill, your car loan. Well, the grocer doesn't care how he gets his money just as long as you pay him. He's still getting paid. Your debt doesn't affect his bottom line yet. But what happens when you can't borrow anymore and you run out of money? Well, his bottom line's going to feel it then when you stop buying groceries. Same thing with national debt. Companies and citizens don't feel it yet because the money is still flowing. But just wait until it is not. You will feel it then, I promise you. I think for investors, it would just be prudent to start taking national debt and deficit spending into our accounting of what we think will happen in the years to come and begin to position accordingly. There is a rising and deafening crescendo of warnings that America will be left with severe, irreversible scars if national debt goes unchecked. And as recently as just a few weeks ago, Congress killed off the most recent plan to tackle the crisis. And once again, we are kicking the can, and soon we won't be able to kick it much longer. You know, one of the reasons we're working with David McKnight in Tax for Retirement is because we believe that national debt and national spending will cause taxes to rise and spending to fall in the future. Both of those would be negative outcomes for the stock market. And even if Trump is elected, he doesn't control tax rates. As much as he would like to reduce tax rates and keep them low, he's not in control of it. Congress is. And it's my belief that our country is heading into some dark times. And as former U.S. Comptroller David Walker says, if we don't fix this within the next 5 to 10 years, this country is in dire straits, as in an economic debt spiral from which we cannot recover. I certainly hope it doesn't come to that, but so far, there's not much being done about it. Number 2. A possible recession. And while we haven't seen the full impact of it yet, most economists believe the recession is functionally inevitable. The question becomes how deep and how far. And again, one of our more respected research departments suggests that a soft landing is possible, but we also agree that the full impact of rising interest rates has not been felt yet. We are starting to see more and more indications of a possible recession, as in some of the metrics that we follow are being shown in 19 states as possibly coming. Oh, wait, was that 21 states, are showing possible recession. And the economy is flashing recession warnings. And with difficult and disappointing years at UPS and shipping, and some people say a hard landing recession is virtually guaranteed. We believe that any one systemic shock to the economy could trigger recession much more quickly and much more deeply than people imagined, which leads to number 3. The potential for an outside shock to send us over the edge, and the most popular theory is that an oil price surge will be the number 1 threat to the U.S. economy, and that as we roll into the summertime, we could easily see a return to $5 a gallon gasoline. Frankly, rising fuel prices was the break point that led us to the housing crisis in 2008, when the price of oil crossed over $140 a barrel. Although I think the far bigger possible shock as we are monitoring is a looming real estate crash. Just look at all the empty buildings in downtown Hartford and multiply that by all the cities in the world, and you have an idea of what I am talking about. Check it out. For the price of a Santa Monica bungalow, you could have bought the largest building in St. Louis. A building that sold for $205 million in 2006 just sold for $3.5 million. People who follow this stuff feel the commercial real estate meltdown will be worse than the global financial crisis, that a return to the office is dead, And one real estate CEO predicts that hundreds of banks will fail or be taken over. And could that be the trigger that turns everything south? Or could it be geopolitical turmoil, as in war in Ukraine and along with the war in Gaza, and now with the recent Chinese military drills off the coast of Taiwan that prove that China could take over that small island nation within 1 hour and we wouldn't even know about it until it is already done. P.S. Do you realize that Taiwan is where NVIDIA is? And where the world's almost completely rely on Taiwan for the semiconductor needs, and semiconductors is now the most valuable resource on the planet? Ray Dalio, in his recent article, discusses the 100-year storm on the horizon with China, and that domestically it is a very difficult time for China, and the pendulum is now swinging more and more towards an autocratic and military build-up direction. And with their 100-year game plan to restore world dominance, Chinese dominance in place, they are trying to control as much as they humanly possibly can. You know, in my heart of hearts, I would like to be an optimist. I always try to see the bright side of things and the opportunities rather than the pitfalls. But I think we ignore the pitfalls of this economy and this administration at our peril. With this in mind, I would continue to recommend conservative and stable and predictable investments, although I'm not going to shy away from also continuing to recommend and suggest that if you have equity or stock positions that you like, that maybe it's okay to hang on to them for a little while. For now, I would strongly encourage you, though, to have an exit plan in place and safety valves that can protect the value of your accounts in case things head down very sharply and possibly very quickly. In the end, as always, please don't hesitate to reach out if you'd like to discuss in detail or if you need additional support. Our interns will also be making phone calls over the summer to follow up on individual situations as they arise. And please be sure to save the date of Friday, July 19th for our 12th annual client dinner in downtown Hartford, where we will dig into this in more detail with our special guest, David McKnight, and have the opportunity to interact with him and each other and to share our thoughts. You know, I believe it is one thing to meet with your financial advisor one-on-one at the kitchen table, but it's a completely different thing altogether to get together with 200 other clients in the same room to be able to synergize, network, share ideas, and interact. And I hope to see you there. Please have a safe and productive summer, and see you soon. And thank you, as always, for your continued confidence in the work that we do.